So today I want to introduce you now to the calculation of the adjusted cost base and the taxable portion of a policy gain. And remember, all of this applies, of course, basically to insurance policies and everything else. So in this particular case, what we want to do is take a look at if we actually have a gain in our cash value, essentially, how much of that will be taxable. So that's why we refer to this as the calculation of the adjusted cost base and then the taxable policy gain. So we've got a situation here. We've got, first of all, the policy itself. This only applies for policies that were last acquired from December the 1st, 82 onwards. Okay, so this does not apply for anything that was purchased before December 2nd, 1982. It falls into a whole different regime altogether. So for our purposes today, we only want to focus our attention on policies that were actually from December 1st, 1982 onwards. And the example that I have here for you is basically we have a client just received a statement, you might say, from the insurance company, whatever it is, and he notices in his statement he's got $50,000 in cash surrender value. And he's wondering now how much of that $50,000 would in fact be taxable in the event that he made any kind of withdrawal. In other words, what is the policy gain? And as you know, according to the Income Tax Act, whenever you have a policy gain, whenever you have gain of anything at all, you must pay your taxes. Okay, so therefore the question really is, what is that policy gain? So in order to establish that, we have to establish, of course, what is the premium. Okay, the premium was $2,000 per year, and this was 10 years later. In other words, he got his statement 10 years later. He received that. So basically, the total premiums that he paid was $20,000. Okay, $20,000. That was the total premium in 10 years. So the first thing, step one, basically, is the first thing we have to establish is calculate the adjusted cost base. Now remember, the definition of adjusted cost base is what did it cost me to actually buy this particular product. So that's basically in its rawest form, you might say, the definition of adjusted cost base is what did it cost me. So if you buy, for example, a piece of land or whatever, so you bought it for $90,000, let's say, and then you had a $10,000 expenditure, lawyers, whatever it is, then your cost of buying that land was $100,000. It's the same idea here, basically. So what we're saying is, what did it cost me to actually buy this? Because the adjusted cost base portion, okay, which is the portion that you actually spend to get that particular item, that is basically a refund of your own money. So you're not going to get taxed. So the first thing to note about ACB is that the ACB itself is a return of your own money. And so the end result is that it will be tax-free. So all we're looking at here is what did you earn over and above the ACB. That's really what we're looking at. So therefore, in order to establish that, the very first thing we have to say is, well, what did it cost me to buy this particular policy? So in this case here, the first one we have here is what we call non-participating whole life. Okay, so basically this applies to whole life insurance, universal life, things of that nature that are non-participating. In other words, no dividends or anything along that line. Okay, so it's non-par. So please make sure that you clearly understand that this is a non-par situation. Okay. So the total premiums paid throughout that 10 years, of course, as I said, was $20,000. Okay, that's fine. And since December the 1st, 82 onwards, what Ottawa has basically said is that not only did you pay a premium, but during that particular period of time, we actually insured you for whatever that amount was. It could be $250,000 for the coverage. That's not the important thing, okay? The point is that basically what Ottawa is basically saying is that we actually paid, yes, you gave it $20,000, but remember, you received the benefit, and that benefit was that we insured you for the last 10 years, let's say, for $250,000. And so, therefore, what did it cost us to insure you during that 10 year? Well, that is where they come up with what's called net cost of pure insurance, so NCPI, okay, the net cost of pure insurance. So this is basically saying, okay, during that same 10-year period of time, yes, we recognize the fact you paid in $20,000, but you must also recognize that during that period of time, we also paid on your behalf $5,000 in this example, let's say, to actually insure you, so that if you had died, we would have had to pay up $250,000. And so therefore, to make sure that $250,000 is tax-free, you have to pay your tax on it now. And so therefore, that tax you're paying will be on that $5,000, basic, okay? So the capital gain calculation then is basically the formula. It's premium paid, because the ACB formula is premium paid minus your NCPI. So notice that that the NCPI is a negative. It's a negative. So therefore, you paid us $20,000, but we gave you a benefit of $5,000 to buy the insurance. So therefore, you did receive a benefit. So we didn't then have to take out that benefit from your premium. So your new ACB now is $15,000. So in other words, the $15,000 that we're talking about here, that portion will come to you totally tax-free. That's just simply a return of your own money, and that's the end of it, because you already paid your taxes on that money. And remember, all premiums are paid with after-tax dollars. Okay, so therefore, that $15,000 is basically a return of your money, and so therefore, nothing to worry about. So if all you do is just simply withdraw simply the ACB, then it will be tax-free. So the question, really, the second part of this will be, okay, now that we know what it costs me to buy this particular item, okay, how much of that will in fact be taxable? And that's when we go into the step 2, which will be the actual policy gain itself. Okay.